Welcome to my YouTube channel. Equityverse means universe of equity. Here only equity and mutual funds return analysis are done and uploading video on this YouTube channel Equityverse. To welcome to this detailed research analysis of Nippon India Large Cap Fund. Today's topic is Nippon India Large Cap Fund growth. We will analyze about this mutual fund. In this session, we evaluate the fund using professional parameters, performance, risk, portfolio insights, manager quality, and long-term consistency. This report is designed for investors, analysts, and finance students seeking a structured and data-driven analysis. But you must know, this video is only for educational and learning purposes. We are not registered with SEBI. We strongly advise you must consult a financial advisor before making any financial and investment decisions. Investment securities, mutual funds, share market are subject to market risk. So you must consult a financial advisor and read all the annual report and other necessary documents of this mutual fund. Now let us start this report. These parameters establish the fund's identity. It is one of the largest large cap schemes in India with a long tenured manager and a core focus on the top 100 Indian companies. Let us look at a fund snapshot. The basic parameters. Categories are large cap fund, large cap equity fund, benchmark BSI 100 TRI, and asset under management approx 48,000 plus crore rupees. Expense ratio is 1.49% regular, lower for direct. Fund managers are Shailesh Raj Bhawan and Bhavik Dave. The fund, it is one of the largest cap fund schemes in India with a long tenured manager and a core focus on top 100 Indian companies. The fund is aimed to capture strategic compounders in India's large cap universe. Its strategy focus on stability with the selective alpha generation. Investment objectives and strategy. What are objectives of this mutual fund? Long-term capital appreciation. Predominantly invest in large cap companies. Follows a growth oriented and benchmark aware approach. Strategy focus. What are strategy? Market leaders in sectors. High earnings visibility. Strong cash flows. Moderate turnover. And what are the key parameters? Before knowing this, we have to know fund type objective. This is open-ended large cap equity scheme seeking long-term capital appreciation by investing predominantly in large cap stock top 100 by market cap. Fund managers are Shailesh Raj Bhawan, managing since August 2007, and Bhavik Dave, co-manager since August 2024. Long manager tenure is notable strength. Benchmark, because if in any financial analyst, fund managers are working for long term, it means you have a large capacity and experience. Benchmark use official AMC BSE 100 TRI. TRI means total return index. Some aggregators may show alternate index variants prefer the AMC stated benchmark. AUM expense turnover latest AUM 48,871 crore rupees as on 31st October 2025. Expense ratio is 1.49, turnover 25%. These are in line with large cap active peers. Expense slightly more, the very cheapest large cap funds. Now move to key parameters. Inception. Inception August 8 August 2007. Regular plan. Direct plan inception letter. Minimum investment SIP systematic investment plan. Minimum rupees 100, lump sum and SIP. Exit note is 101%. If redeemed within 7 days, mandate invest more than 80%. in large cap stocks may invest rest in cash, debt, REIT in VIT as secondary objectives. Equity exposure. Equity allocation 98 to 99% in equities, cash and equivalents 1%, market cap split 73%, giant 20.5%, large 6%, mid. Tilted to large names, cash 1 to 2%, market cap allocation, giant cap 73%, large cap 20%, mid cap exposure 6%. Top holders are of this mutual fund. Top 5 holdings are approx percentage of portfolio. First is HDFC Bank 8.36%, Reliance Industries 6.25%, ICICI Bank 4.54%, SBI 4.46%, and Axis Bank 4.29%. What are the performance view? Before going to performance review, we have to comment on portfolio composition. The fund is heavily tilted towards banking and financial services, as you see. Bank in top holdings holders are banks. From in banking share, these funds are invested. This typical for large cap funds but introduces sector concentration risk. Now move to performance review. Returns, direct plan, these are approx figures. 1 year 7 to 8%, 3 year CAGR 19%, 5 year CAGR 22.25%, since inception 13%. Comparison versus benchmark, outperformed BSE 100 TRI on most rolling periods, higher alpha generation in this last 5 years. What the interpretation of this? Performance has been strong over medium to long horizons, showing consistent alpha creation, especially during market up cycles. We see later what the alpha these are. Now these are interpreted as follow. The fund has delivered strong multi-year returns and materially outperformed the BSE 100 TRI benchmarks over several rolling and static windows. What is static windows? Static support and resistance levels are, as you know in technical analysis, static support and resistance levels what are fixed price points on a stock chart that historically have represented areas of significant buying or selling pressures. In recent years, differences in numerical values across sites reflect snapshot dates and plan, direct versus regular. The qualitative conclusion are consistent outperformance over 3 to 5 years is robust. Now, rolling return analysis. Rolling 3 years and 5 years return. 3-year rolling returns frequently above benchmarks. It is above benchmarks. You have to share index markets above it is performed. 5-year rolling returns show high consistency, very few negative rolling periods. Rolling returns analysis removes time period bias. Nippon India large cap demonstrates stability and consistency, a hallmark of quality large cap funds. Now move to risk matrices. What are risk matrices? Key indicators are standard deviation. Standard deviation are 11 to 12%. The fund has a moderate level of volatility and risk. It indicates that the fund's return historically fluctuate by around 11 to 12% percentage points above or below its average return, approximately 68% of the time on standard deviation. Beta 0.9 to 1.09. The fund price is expected to move mostly in line with its benchmark index, indicating a risk profile that is close to the overall market average. Maximum drawdown, the percentage drop in its value from a peak to a subsequent trough, significant during market crashes but control versus peers. Downside deviation moderate. The fund maintains volatility close to its benchmark while it does take active calls, the risk remains fairly controlled. Now, risk adjusted performance. Core ratios are Sharpe ratio, Sortino ratio, alpha and R squared. We discuss these one by one parameters. Sharpe ratio 1 to 1.1 is very strong. This is a strong ratio. It is considered good or acceptable. It means the fund has provided a reasonable level of return for the amount of risk volatility it has taken one. Above a risk-free investment such as government bond or fixed assets. Sortino ratio greater than 1. A Sortino ratio greater than 1 for a mutual fund means it is generating a good risk adjusted return by creating more returns than the downside risk it is taking on. This indicates the fund is efficiently managing its negative volatility and is a positive sign for risk averse investors. Now move to alpha. Plus 3% to plus 4% over benchmark. The fund's actual performance has exceeded its expected return benchmark by 3 to 4 percentage points after adjusting for the level of risk taken. R squared, high correlation with benchmark. A high is R squared, typically 70 to 100% for a mutual fund, indicates that the fund's performance is closely correlated with its benchmark index and that most of its movements can be explained by the market's movements. These ratios highlights that the fund is not only delivering strong returns but does so efficiently rewarding investors for each unit of risk. Very good going on by Nippon Mutual Fund. Now, risk adjusted performance. Annualized distant deviation. Interpreted the above results. Annual standard deviation 11.6% approx varies slightly per provider and per period. Beta versus benchmark 0.9 to 1.09 depending on provider per period. Roughly index like sensitivity. A beta slightly below 1 suggests marginally lower market sensitivity on some windows. Sharpe ratio analyzed 1 to 1.0. This is healthy Sharpe for an equity large cap fund. Alpha or Jensen alpha provided so positive alpha 3 to 4% on some windows indicates the fund has added active value net of systematic risk on those periods. Taking here one provider 7%. This indicates the fund does deviate meaningfully from the index. Active stock per sector bets. Maximum drawdown and downside behavior. Research shows that the performance is uneven at times. It has had periods of underperformance and higher volatility relative to benchmark in certain stages. The interpretation like this risk and risk adjusted metrics are solid. The fund has delivered attractive Sharpe and positive alpha in recent measured windows, but with moderate tracking error and occasionally volatility, its active stance not hugging the index drives both alpha and higher dispersion versus benchmark. Now we talk to style and other factor exposures. Style characteristics are this fund is growth oriented, large cap focus, low to moderate turnover, 25% sector wise banks and financials. Manager review, fund manager strength, Sales Raj Bhavan, managing since 2007, very experienced fund manager, highly experienced in Indian equities, consistent investment framework, long-term stable leadership. The fund's concentration in banking and financial services is a major driver of both its returns or risks. The fund's performance is deeply tied to the manager's long-term approach, which has sustained across multiple market cycles. Investment philosophy focus on large cap leaders or emerging leader companies with a strong ROE, cash flows, and aim to generate alpha while owning core index names. AMC states it invests predominantly in top 100 companies. Manager tenure and continuity. Sales Raj Bhavan has run the strategy since August 2007. Long tenure. Co-manager added August 2024. Long single manager history gives confidence in process stability, though any manager change should be monitored. Turnover activity, turnover 25%, which means moderate turnover consistent with bottom-up stock selection rather than index tracking. A mutual fund with a 25% turnover ratio means that on average 25% of its portfolio holdings were bought and sold within a year. This indicates that the fund manager is moderately active, buying and selling assets at a rate that results in one fourth of the portfolio being replaced over the course of a year. What is the strength of this fund? A strong long-term track record, high consistency in rolling returns, as we have seen just on one slide. Rolling returns for a mutual fund measures the annualized average return over a specific moving time period, such as 3 years or 5 years rolling returns, unlike fixed point-to-point returns which only show performance between two specific dates. Rolling returns provide a more consistent and comprehensive view by continuously recalculating performance over successive overlapping periods. This method gives a better sense of how a fund performs across different market cycles and helps to smooth out volatility. Experienced manager, the strength of this fund, lower downside risk compared to peers, suitable for SIP due to stability. These strengths make it a strong contender as a core large cap allocation in investor portfolio. Weaknesses and risks. High exposure to financials. Regular plan has relatively high expense ratio. Active bets create periodic deviations from benchmark. In a mutual fund, active bets refers to a professional fund manager's deliberate decisions to buy, sell and hold securities with the goal of outperforming a specific market benchmark index like Nifty 50 or S&P 500 rather than simply replicating its performance. This is the miraculous performance by the fund managers that outperform a specific market benchmark like Nifty 50 and S&P 500. So this is called active bets. Not ideal for short-term investors. This is suitable for long-term investors. Suitability best for 5+ year, more than 5 years investment horizon. SIP investors, core equity allocation, moderate to aggressive investors. Not for short-term investors, investors seeking very low cost index exposure. The fund is active nature, requires patience. Investors should expect occasional short-term underperformance. Suitability. This makes it ideal for goal-based investing where stability and growth are both important. Peer comparison. The fund is typically rated 5-star highly value research and it sits among the largest well-known active large cap funds. It typically outperforms many passive large cap indices over 3 to 5 years but can lag at times. Consistency across all periods is mixed. Compares with SBI large cap, HDFC large cap, ICICI Prudential large cap in peer set. Strength and differentiation. Long-term track record since 2007 proven through multiple market cycles. A strong multi-year return 3 to 5 years averages materially above benchmark in recent. Healthy risk-adjusted metrics. Sharp ratio 1. Positive alpha on many windows. Large AUM and scale. Deep pocket to absorb redemptions and operational stability. Risk and weaknesses. Active volatility tracking error. The fund takes active bets. This produces variance. It has periods of underperformance and is not index hugger. What is index hugger? An index hugger is actively managed mutual funds that closely follows the holdings and performance of a benchmark index like the S&P 500 but charges higher fees than a passive index investor. Should be prepared for uneven relative performance. Expense ratio for regular plan is moderate 1.49%, cheaper direct plan returns are better. For long-term investors, prefer the direct plan to reduce the feedback lowering the negative impact of expenses or your investment returns. Concentration in financial and bank stocks. Top holdings show a heavy weight to financials: HDFC Bank, ICICI Bank, SBI, Axis Bank. Sector concentration can amplify sector-specific drawdowns. Suitability recommended investor profile. Who should invest? Investors seeking active exposure to India's large cap segment for a more than 5-year horizon, wanting potential outperformance versus BSE 100 Nifty with tolerance to occasional higher volatility. Suitable for moderate to aggressive equity allocation within a diversified portfolio. Who should avoid? Investors seeking index-like returns, ultra-low fees, or needing equity within less than 3 years. Summary and verdicts. Final assessment. A strong large cap fund with consistent outperformance, positive risk-adjusted returns, long tenured manager, slight sector concentration risk, the increased vulnerability a fund has to adverse events or downturns affecting a specific industry or economic sector due to large portion of its assets being invested there. Recommended for long-term wealth creation, direct plan preferred. Practical recommendation, that is XML. If you want active large cap growth potential, prefer direct growth plan, lower expense ratio there, and invest via SIP. To smooth entry, direct plan shows better historical direct returns. What are allocations of the shares? Limit to a reasonable portion of equity allocation. For example, 20 to 40% total equity allocation if you also hold mid-small multi-cap funds. Avoid concentration across multiple funds that own same top large caps. Monitoring review quarterly. Watch for manager changes. We should see the changing of managers. AUM drifts refers to a what are AUM drift refers to a situation where the fund manager is compelled to deviate from the fund's stated investment mandate or style due to sheer size of the assets. Their managing expense changes a material mandate drift. And what is the mandate drift? It refers to a style drift, which is when a fund manager's investment strategy significantly deviates from the fund's stated investment objective. Benchmark a mandate. Keep an eye on sector concentration, that is banks of finance. What is the monitoring checklist? Quarter by check, manager changes, portfolio sector weights, rolling 3 to 5 year returns, changes in expense ratio, deviation from benchmark, rebalance annually. Our final verdict: a strong, reliable, actively managed large cap fund suited for long term investors with moderate risk tolerance. Use this checklist to ensure the fund continues to meet your expectations and maintains process discipline. Investor scorecard. Performance: 5-year strong, 20 to 26% per annum depending on direct regular sources. Risk volatility: 3-star, standard deviation 11.6%, tracking error moderate. Risk adjusted 4-star, sharp 1.0, positive alpha, cost 3-star, expense ratio 1.49, regular. Use direct plan to reduce manager process, long tenure 4-star, long tenure and current process. Overall view: recommended for investors who want an active large cap core holding and can tolerate some tracking variance. Use direct plan plus SIP plus 5-year plus more than 5-year horizon. This video is only for educational purpose, not for investment recommendation. Thank you for going through this detailed research presentation. It can now generate charts. Then we will meet next video for this. Thank you for watching this video. If I liked my content, Please subscribe, like and share, and press bell button for that my uploading video can reach to you very short. Thank you for watching.